In 1988, Warren Buffett spent over $1 billion on a single stock, and nearly every value investor on Wall Street thought he'd lost his mind. The stock was trading at 15 times earnings. Benjamin Graham would have called it overpriced. Buffett bought it anyway. That decision turned $1 billion into more than $25 billion. Here's why he was right and what it teaches you about real value investing. Welcome back to Daily Investor. Today we're breaking down one of the greatest investments in history, Warren Buffett's 1988 purchase of Coca-Cola. This isn't just a story about one stock. It's a masterclass in the difference between cheap stocks and great businesses. By the end of this video, you'll understand exactly why Buffett was willing to pay a premium, how he spotted a durable competitive advantage that most analysts missed, and how this single decision reshaped his entire investing philosophy. This is educational content, not financial advice. Always do your own research. To understand why this trade was so controversial, you need to understand where value investing stood in 1988. Benjamin Graham, Buffett's mentor, had built the entire discipline around buying stocks below their net asset value. You wanted stocks trading below book value, below liquidation value, the cheaper the better. Graham called these cigar butts one last free puff of value. And here was Buffett, buying Coca-Cola at roughly 5 times book value and about 15 times earnings. For a traditional Graham investor, that was practically heresy. But Buffett had been evolving. His partner Charlie Munger had been pushing him for years with a simple idea: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Coca-Cola was the test of that philosophy. Between 1988 and 1989, Buffett accumulated roughly 23.35 million shares of Coca-Cola, spending approximately $1.02 billion. That made Berkshire Hathaway Coca-Cola's single largest shareholder, with about a 6.2% stake. So what made Buffett ignore the price tag? 3 things: the brand moat, the return on capital, and the global runway. First, the brand. By 1988, Coca-Cola was already the most recognized brand on earth. It was sold in over 155 countries. People didn't just buy a soft drink, they bought a feeling, an experience, a piece of Americana. That kind of brand loyalty is nearly impossible to replicate. Buffett later said he looked at it this way: what would it cost a competitor to replicate Coca-Cola's brand from scratch? The answer was effectively infinite. No amount of money could buy that kind of global consumer trust overnight. That's what he calls an economic moat, a structural advantage that protects the business from competition. Second, return on capital. This is where the numbers get remarkable. In 1988, Coca-Cola was generating a return on equity above 30%. Think about what that means. For every dollar of shareholder equity in the business, Coke was generating more than 30 cents in profit every single year. Most businesses are happy with 12 to 15%. When a company earns 33% on its equity, paying 15 times earnings isn't overpaying, it's getting a compounding machine at a reasonable price. The higher the return on capital, the more valuable every retained dollar becomes over time. Third, the global growth runway. In 1988, the average American was drinking roughly 296 8-ounce servings of Coca-Cola products per year. But globally, the average was only about 39 servings. That gap represented decades of growth as markets in Asia, Eastern Europe, Africa, and Latin America opened up. Roberto Goizueta, Coca-Cola's CEO at the time, had a famous line: the company's market share of total worldwide fluid consumption was less than 2%. The growth potential was staggering. Buffett wasn't buying a mature, slow-growth business. He was buying a global growth story hiding inside a 100-year-old company. Now let's look at what actually happened after Buffett bought in. This is where the power of a wonderful business becomes undeniable. Coca-Cola's earnings per share grew from about 36 cents in 1988 to roughly $2.69 by 2024, a nearly 8-fold increase. Revenue grew from $8.3 billion to over $45 billion. And the stock split 5 times, 2 for 1 in 1990, 1992, 1996, 2012, and a later adjustment. After all those splits, Berkshire's 23.35 million shares became approximately 400 million shares. At a recent price near $62 per share, that position is worth around $25 billion, roughly a 25x return on the original $1.02 billion investment. But here's the part that doesn't make the headlines: the dividends. This is the real magic of the investment. When Buffett first bought Coca-Cola, the annual dividend was about $0.075 per share on a split-adjusted basis. His 400 million split-adjusted shares generated modest income at first. But Coca-Cola has raised its dividend every single year for over 60 consecutive years. By 2024, Berkshire Hathaway was receiving approximately $776 million per year in Coca-Cola dividends alone. Let that sink in. Buffett is collecting over 75% of his entire original investment back every single year, just in dividends. He's been paid back his original investment many times over, and he still owns every single share. This is what Buffett means when he says, "Time is the friend of the wonderful business." A great company doesn't just return your money, it returns multiples of your money while you sleep. Now here's the lesson most investors get wrong. They look at Buffett's Coca-Cola trade and think, he got lucky, or that was a different era. But the principle is timeless. Benjamin Graham taught that the margin of safety comes from buying below intrinsic value. That's true. But Buffett evolved that idea. He realized that for a truly exceptional business, one with high returns on capital, a wide moat, and a long growth runway, the margin of safety can also come from the quality of the business itself. A cheap stock with no moat can destroy capital. An expensive-looking stock with a durable moat can compound wealth for decades. The key question isn't, is this stock cheap? The key question is, will this business be stronger in 10 years than it is today? If the answer is yes, and you can buy it at a reasonable price relative to its earnings power, you don't need a bargain. You need patience. If there's one principle I want you to take from Buffett's Coca-Cola investment, it's this: don't confuse cheap with valuable. A stock trading at 8 times earnings can be expensive if the business is deteriorating. A stock trading at 15 times earnings can be a bargain if the business compounds at 30% a year for decades. The margin of safety in a Coca-Cola isn't the discount to book value, it's the durability of the moat, the power of the brand, and the certainty that people will still be drinking Coke 30 years from now. As Buffett has said, price is what you pay. Value is what you get. His billion-dollar bet on Coca-Cola proves that value can live in places where price-obsessed investors refuse to look. That's the real story behind Buffett's greatest investment and why paying too much turned out to be the smartest move of his career. If this helped you think differently about value investing, subscribe so you don't miss tomorrow's video. I'll be breaking down one of the biggest behavioral traps that costs investors thousands every year. Drop a comment, what's a stock you think has a Coca-Cola level moat today? I'd love to hear your thinking. Until next time, stay patient, stay disciplined, and always invest in what you understand.